Hey everyone, thanks so much for joining us. My name is Denise Loria. I'm the Special Projects and Operations Manager at AFC. Today we're bringing you the final webinar of our series, Webinar Wednesday. We started this series to enhance our policy summit, which is taking place next week, November 18th at the Westin DC City Center, and we're actually all sold out. So today we're going to be talking about payments. We have a great panel for you guys. It's going to be a great conversation. I will be in the chat, so if anybody has any questions, feel free to drop them in the chat. We encourage, some engagement. And I'm going to pass it over to James, who's going to kick off the webinar.
Fantastic. Thanks so much, Denise. I am James Wigginton. I am of counsel in Orrick's crypto and blockchain practice, and I'm really pleased to be able to moderate today with our distinguished panelists. So to get started, why don't we go ahead and do a quick round of intros? And Keith, if we could start with you, if you could tell us who you are and what you do.
Sure. Thanks, James, and thanks, Denise. Thanks to the AFC. I'm looking forward to this conversation. I'm the GM of BVNK in the Americas. BVNK is a stablecoin infrastructure provider. We're a global company with offices in London, Singapore, New York, and San Francisco. I've been with BVNK for 11 months. Prior to that, I was leading the payments team at Cross River Bank. Also worked at American Express, First Data, and I started my payments career at Western Union. So looking forward to this again.
Excellent. Thanks, Keith. Deron.
Yeah, I'm Deron Hicks. I'm head of government relations for global payments, and we're, of course, a global merchant acquirer. Been with Global or TSYS. I actually came from the TSYS side of the house, the issuer side of the house, for 13 years now, based down here in Georgia.
Excellent. Thank you. Nick.
Thanks, James. It's great to be here. I'm Nick Elledge. I'm Chief Operating Officer and co-founder of Stablecore. Stablecore is a digital asset sidecore. So we sit alongside Jack Henry, FIS, Fiserv, and other cores in order to provide digital asset services to customers of banks and credit unions. We do that by integrating in with the digital assets and blockchains and integrating that in with the legacy technology stack. Again, it's great to be here. Thanks for the invitation.
Wonderful. Thanks, Nick. And last but not least, Jesse.
Hey, Jesse Honigberg. I'm EVP of Product and Platforms at Customers Bank. I'm responsible for building our products and our platforms. But I think that I'm primarily for this conversation, work quite a bit with our digital asset customers, including kind of half of the responsibility, the technical responsibility for our Cubix platform, which is a settlement platform used by a bunch of the larger digital asset clients. Before that, I had the pleasure of working with Keith at Cross River. And then before that, I was the victim of a traditional consumer bank or commercial bank working for Sterling National Bank, which is now Webster. And so lots of experience across both commercial, consumer, retail, wholesale. I'm excited to be here and definitely a cool panel.
Wonderful. Thanks so much, Jesse and Nick and Deron and Keith for joining us today. And what's really amazing about this group is you have experience not only in the traditional financial world, but in the digital financial world. And that is the topic of our panel today. We want to understand better how digital assets are changing the payments game. I think this is a question that's on a lot of people's minds, especially after the passage of the Genius Act over the summer. And so to set the table, I would like to direct a question to Keith. There are many different kinds of digital assets. There's as many as you can imagine. There's probably somebody who's digitized it or tokenized it. But for purposes of today's discussion, we're going to be focusing on two different types of digital assets, and those are stablecoins and tokenized deposits. And Keith, I was hoping that you could help us define what a stablecoin is. For some people in our audience, they probably already know what a stablecoin is, but I think it would be helpful to have a common lexicon. And then to help us understand how stablecoins are different from tokenized deposits.
Yeah, sure. Thanks. And obviously anybody else feel free to add in specifically on the tokenized deposit. But a stablecoin is a digital representation of a fiat currency. Most common is the US dollar, but there are other fiat currencies that have stable coins like euro, and I believe there's some Asian stable coins, but primarily we're talking about US dollar stable coins. And there are issuers, BVNK is not an issuer, but there are issuers who will mint these digital assets, and they are fully backed by fiat. Most often that is Treasury. Circle is a very popular one, and they have a level of transparency. You can go to circle.com transparency and see all the different fiat that is backing USDC, which is the stable coin that Circle issues, USDC. And you can see the fiat backing that. Again, most of that is in US Treasuries. The market share for stablecoins is primarily made up of Tether, USDT, and USDC. There's a number of new stablecoins being issued out there, but right now between those two issuers, they make up something like 98% of the stablecoins in circulation. But they're really intended as a payment mechanism. We talk about some different characteristics of stablecoins relative to fiat. So they're 24/7. They're instant, unlike some fiat payment rails, ACH, or traditional wires. They're very similar to RTP and FedNow domestically, or if you're thinking about internationally, UPI or PIX in the 24/7 and instant nature of stablecoins. They are global, so unlike RTP and FedNow or ACH, they are universal, like they cross borders. So in that regards, it's very similar to SWIFT. And then the other unique characteristic of stablecoins is they are programmable. So you can write logic using a smart contract to trigger certain events. There's also a degree of transparency in stablecoins that provides, most often it's a conversation with the compliance department, provides a level of transparency that you don't get in traditional fiat. You can go on-chain using on-chain analytics tools to track the various different wallets, the digital wallets that have held that stable coin. So it's not driving any specific use cases around its transparency, but it does help BSA ML teams within companies using stablecoins to track those. I would say relative to tokenized deposits, and this really has come to light with the Genius Act and then MiCA in Europe. But relative to tokenized deposits, the Genius Act made it very clear that stablecoin issuers cannot pay yield or cannot pay interest directly to the holders of those stablecoins. And there's a few other requirements, but that I would think it would be the biggest differentiator to tokenized deposits. It's important to note tokenized deposits outside of the JPM coin, there hasn't been significant scale yet. And most of those, I think there was just an announcement today, most of those are on private blockchains versus stablecoins are on public blockchains. Most of those, it's going to be on Ethereum,
Right.
or Solana or various.
So this is a question I think for you, Keith, but really for anybody, which is, tokenized deposits, if they're not really mainstream yet, if they're mostly on private blockchains, why are people talking about them? Why are people so interested in tokenized deposits versus stable coins? Like what is the what are the use cases that people are excited about?
So I think some of the use cases are, yeah. So some of the use cases are similar. So payments use cases, cross-border. I think there's some other things that can be done with tokenized deposits. And specifically for US banks, I think many of them view tokenized deposits as a complementary offering relative to stablecoins. And it's something that these banks can issue themselves, the tokenized deposits versus stablecoins.
Yeah.
Got
I
it.
think
Okay.
there's a kind of a key thing, right? And, I think that ultimately you can lend against tokenized deposits, right? And so you want to know the single biggest reason why banks are talking about it, because there's actual business model behind it. And so like a stable coin is probably not, beside being, unless you're a mega bank, right? It's probably not going to be profitable for you because you can't lend. Versus a deposit token, in theory, it's the same as anything else, right? The US dollar has value because people think that the US dollar has value, right? And so like if your deposit token you say it's worth $1 and people believe it's worth $1, you can then lend against it, right? And so you kind of go to like a pseudo fractional reserve model with a digital token. And so I think like that's probably the most important aspect of it for community banks and for smaller banks to kind of wrap their heads around.
Got it. Okay.
I'd add, James, that those are great explanations just in terms of explaining what a stable coin is. We hear a lot that they're cheaper and faster. And the reason for that is that they are a liability of an issuer. So, for example, USDC is a liability of Circle, and they're a bearer instrument. So, just to break that down, that means that the value is transferred with it that's being passed around. So, you could just write the series of numbers and letters that represent a stablecoin on a sticky note. And I could pass that to Keith, who could pass that to James, who could pass that to Jesse. And then we've just completed 4 transactions, but no dollars have actually moved. All we did was move that IOU, which at any point someone could take back to Circle and get $1 for. But all we've done is pass it on. That's why it's faster and cheaper. So all we're doing is sending the IOUs. That's why it can cross borders very easily as well. Because just so long as everyone has confidence that this is fully backed, according to the Genius Act, there's a Genius compliant payment stablecoin, that at any point we could go back and redeem it for $1, and that gives us confidence to have transactions between each other.
And I guess, just to put a slightly finer point on it, at risk of, sort of stating the obvious, I think a stablecoin is supposed to be a medium of exchange. And I don't think, correct me if I'm wrong, that a tokenized deposit is really viewed as a medium of exchange. I don't, pay somebody for goods or services using a tokenized deposit, would I?
You can.
Good.
Why couldn't you? I mean,
Good.
it's whatever you want, right? I could pay you in wampum as long as you'll take it. It's an exchange of good and consider, right? So I mean, I think like we don't generally think about bartering as like a good, an efficient means of exchange, right? But like, effectively, if two people believe it has value, right? And so like there's nothing saying that you can. I think Keith brought a point that it needs to really be on a public blockchain effectively, because if it's not, then your ability to verify the double spend problem and some of that other stuff becomes very difficult. But a deposit token on a public blockchain, sure. I mean, why wouldn't it work?
Mm-hmm.
Yeah, and I do think it's important, specifically for any banks in the audience who are thinking about this, about for it to be an effective medium of exchange, you need to have broad acceptance. Being on a public blockchain is one thing, but then the other thing is, network effects. The card networks spent a long time building out their networks to increase accessibility. You do need that either interoperability or kind of the critical mass of acceptance of your specific token. We say we're stablecoin agnostic, and we will list and support any stablecoin that does have critical mass. But there's quite a few stablecoins that we wouldn't support just because there's not enough demand for them.
Mm-hmm.
And
Darren, I want to.
oh,
go ahead, Nick, and then I want to direct the question to Darren.
Yeah, at Stablecore, we most of our team came from Coinbase, and we think about this a lot, and we have a viewpoint on where it's going in the future and how it fits in. So we think that there probably are going to be a few very popular B2C stablecoins or consumer stablecoins. So Tether and Circle, for example, and it's going to be very tough to surpass the network effects and the consumer acceptance, the global consumer acceptance of those coins. But on the other end of the barbell, there are probably going to be a lot of B2B stable coins, meaning that maybe ones that operate between businesses, that you don't need consumers to know about it, but it processes a lot of volumes. And there may be examples of businesses that have already launched those. Western Union might be an example of that. JP Morgan's coin may be an example of that. And tokenized deposits may be something of a subset of that, where this is a transaction between banks only, and it has to meet certain requirements for safety and soundness. It has to qualify as a deposit, has to stay within the licensed banking system in order to get that FDIC insurance, in order to qualify for deposit status. But it's kind of a subset of almost like a private B2B stablecoin that would exist between banks.
Interesting. I think that's a useful way to think about it, at least, for the time being, as stablecoins being something that might be of more interest or use in the B2C context versus the B2B context. Interesting. Deron, the question that I wanted to direct to you is, now that we have sort of a working understanding of the difference between a stablecoin and a tokenized deposit, how are those things treated differently from a regulatory perspective? I think everybody on the call is familiar with the Genius Act. We know more or less what it does. I think a question that's interesting to many of us is, how does the Genius Act tip the scales in favor of or against stable coins versus tokenized deposits? Obviously regulations can affect whether a product is attractive or not. And so we're curious to hear your perspectives about how regulation is changing the balance.
Yeah, so we have the regulatory framework established in the Genius Act. I mean, we're talking only July 18th that this got signed into law. So we're like at the very start of this regulatory process. And, I think even under the best set of circumstances, so you have the framework set up by the Genius Act, and now we start building out the regulations. In like a best case scenario, you're looking at 12 to 18 months, right, to get fully realized set of regulations. And we're going to have some herding of cats here, because we're talking about Treasury, Fed, FDIC, National Consumer Union, so OCC. All of them have some role to play in this. And then, of course, all of us who have been through some sort of like new regulatory framework realize that they don't always get it right the first time, right? I mean, so you get a set of regs rolled out, and then you have this period of time where you go, this worked, this didn't work, the unintended consequences of different things. And so when I look at something like where we stand right now, I'm looking at like 4 to 5 years before you have like a fully in place, semi-matured regulatory framework. And you go, wow, man, that's going to be a long time. But the benefit of that is the industry has the opportunity to provide impact as input as those rules are being developed. It is a bespoke set of rules designed for stablecoins. So, I mean, what we're talking about here is a regulatory framework focused on stablecoins. Now we turn to, go ahead.
Oh, sorry, Deron. I was going to ask you, like, do you think you're going to have like an Uber moment here, right? Where you might have a first mover that says, hey, I'm not going to be Genius compliant. I'm going to go out the gates, like kind of like what JPM is, and like say, ultimately the regs will comply to what the market has kind of taken. So, I mean, I agree with you, right? There's going to be this interesting dynamic, but like what I'm wondering is like, is someone going to say, like, let's just go for it and see if I can kind of reach critical mass, and then I'll deal with whatever the regulations say I need to do.
And that in turn, you're right, can then influence what regulations come out at the end, right? I mean, people kind of look and say, do we build a regulatory structure that's so contrary to what's being done at the same time? I mean, I think ultimately, 4 or 5 years from now, you could have those first movers and you see something come out of that. But you're right, you're taking a bet that it matches up with what the end result is, and that you can then switch over. I mean, most mature financial kind of structures ultimately require a regulatory structure that is, sort of consistent and understandable that we can comply with. And so I say that when we talk about stablecoins as sort of this maturity when it comes, but being focused on stablecoins. And then you look at tokenized deposits, and if you do a quick search on what is a tokenized deposit or how are they regulated, you'll see things like, oh, well, tokenized deposits are issued by regulatory entities, and therefore they are regulated products. And that's sort of the pitch you see when you read about tokenized deposits, but not so fast. I mean, so like the Congressional Research Service, which is sort of the think tank for Congress, did a paper last year, and they sort of raised a lot of questions as to sort of, yeah, we've got these brand new things coming out from these regulated entities, but is the system really set up to deal with this, something moving onto the blockchain? The Conference of State Bank Supervisors on November 4th of this year sent a letter out saying, hey, we got lots of questions as to how tokenized deposits work within the existing regulatory structure. Michael Barr, the Fed governor, on October 16th, did a speech where he talked about, the benefits of tokenized deposits are that they come within an existing regulatory framework. And then 3 sentences later, he says, but we need to figure out how these fit into that regulatory framework. And so, like, you have this very general set of regulations that tokenized deposits fit into, but they're not really specific to tokenized deposits, right?
Right.
So the question is whether you want sort of that flexibility, or do you like kind of the specific set of guidelines that you're ultimately going to get out of stablecoins? I mean, I sort of lean towards I'd rather have a set of rules that I know that I comply with, as opposed to this sort of murky kind of, we think they're covered, but exactly how does that work that we see come out of tokenized deposits, like where we stand right now. But,
right.
Like Jesse said, I mean, that could change a year from now,
Sure.
depending on how others move.
What are so with respect to stablecoin regulation, obviously there's still a lot of ground to cover. We don't know exactly where these regulations are going to land. If you had to whittle it down to, let's say, 1 or 2 points of friction where we think there's going to be a robust debate within the industry about where the regulation should land, what would those 1 or 2 points potentially be? And this question is just as much for you, Deron, as it is for other folks.
I mean, I'd say the 2 things that jump to mind immediately for me is this issue of, like, you can't give, you can't give interest on stablecoins. I mean, that was one of the things, but how could they be used in some way? Can you create rewards programs around them? Could, that whole discussion, and because the banks are going to play very heavily on that, right? They like the idea of tokenized deposits or of bank money earning interest, but stablecoins being this standalone thing. So you're going to see some debate in there of, like, what can be done. And then I think the other thing is the recognition of foreign stablecoin issuers. Like, how does that play out and within this regulatory structure?
Got it. Okay. Interesting. Well, it'll be interesting to watch how that plays out. But not everyone is just waiting on the sidelines, of course. There are people who are rolling up their sleeves and getting their hands dirty and starting to issue products, even though the regulations have not stabilized yet. And on that topic, I'd like to direct a question to Nick. Your work focuses on helping banks and credit unions integrate digital assets into their offerings. And I'm curious to hear how banks and credit unions are integrating stablecoins or perhaps even tokenized deposits into their product offerings today. And in your view, what is the most fertile ground for banks and credit unions to integrate these new assets into their product offerings going forward?
Well, that's a great question. Thanks for teeing that up, James. I've literally already spoke with 6 banks before this call today. So we do this all day, every day, and hear their perspectives. The important thing, I think, is that banks understand how quickly this shift is happening and what it means for their core business. Because a lot of folks would say, well, the population that I'm serving, I'm a community bank or a smaller regional bank, and that just folks don't care about digital assets. We don't do a whole lot of cross-border, so why do we need to be thinking about this? There's going to be a wave of adoption within banks. There are banks that are already going live now in 2025. There'll be banks in 2026, and I'd say by 2027. It's just going to be table stakes that you're going to have some way to be able to interact with this. And this was quite contrarian when Stablecore actually was started. So, last year, the viewpoint was that banks would either from a regulatory perspective or just from a technology perspective, never be able to get their acts together to be able to engage with digital assets or stablecoins more broadly. And I think our viewpoint was that these are financial services. This is a payment rail that's rapidly evolving, and you need to be able to serve your customers with however they want to pay people and get paid. And as stablecoins grow in the economy, more and more, we're at 300 billion of supply. That's from virtually zero 5 years ago. So we're already up to 300 billion supply, which is tens of trillions of transactions, tens of trillions of times a sticky note gets passed around. But the supply is 300 billion today, and it's on a zip line by the end of the decade to be up to 3 trillion. And the total U.S. deposit base, and that's not me saying that, that's Citibank, JP Morgan, BCG, all of these projections. So with the total deposit base in the United States being 17 trillion today, you're talking about 3 trillion of not just payments, but also a store of value, especially outside of the United States. People use these as a store of value, as a quasi bank account, but increasingly fintechs are also starting to do that. And very innovative small businesses are starting to do that. So we're seeing corporate treasuries that are denominated in stablecoins, and where they have a stablecoin account, they're managing as many of their payments as possible out of stablecoins. It's programmable, it's faster, cheaper, easier. And so we're going to see more and more small businesses, innovative businesses, and fintechs starting to do that. And so I think the first adopters are ones you've already seen, like Cross River and others who are supporting fintechs that see that capability as essential for corporate treasury. But I think that's the first place we're going to see it for stablecoin specifically is in corporate treasury. That, let's say 3 or 4 months ago when we talked with banks, many of them said, I'm just not getting demand for this. And just in the past several weeks, we've had a number of banks say the corporate CFOs are asking us for this payment rail. And it just takes one. It just takes one time that you need to pay somebody in a stable coin where you have to figure this out. I got to go set up an account somewhere. And a bank is a very logical place to ask and to provide those services. That's our viewpoint. And it creates, a gateway for them to be able to come into this ecosystem and provide that to their customers.
Mhm.
Yeah, and I would just emphasize something that Nick touched on from a
Yeah,
volume
could I?
and a market cap perspective. A lot of the volume is driven outside of the US, right? So historically in the global South or elsewhere outside the US, it's been very hard to get access to dollars, get access and hold dollars. It's rare outside of a very high net worth individual or business would a US bank support non-US residents or non-US businesses. This is a way for many people who have wanted access to dollars to get access to dollars via, a tokenized version of that dollar. And we're seeing businesses and individuals hold those stable coins as a hedge against inflation. So while it might not take off domestically, I do think already we're seeing tremendous demand internationally.
Yeah,
So I
absolutely.
guess Keith,
Go ahead,
sorry,
Jesse.
so Keith and Nick, I guess maybe to take the contrarian point of view, which I never do, right? But I think from the standpoint of, I think about like that use case, right? Like it just sounds a lot like FX, right? And so like I think that from a corporate treasury standpoint, maybe a bank holding some JPM coin or something like that in order to kind of facilitate, quicker money movement for their clients or enable, something along the counterparty trade or something like maybe. But like, I'm struggling to get like the bull case for 50 stable coins, right? Every bank issuing their own stable coin, right? Like I think from a user experience, it'll be horrible, right? Like you can't pay with them, right? No merchant's going to support 50 cash out options. I'm at the Fed fintech conference right now in a room, but like, someone was talking earlier about like the fiat sandwich, right? So ultimately, some point in that chain, right, you need to get it into fiat, right? Unless the entire ecosystem lives in a stable, right? And even then you're going to have to deal with the rehypothecation between if you're moving money between, if all stables trade at 1-to-1, that's great, but they don't, right? And even like, when you talk about BIPs, right, it really matters when the numbers get big. And so like, when you look at the offshore and like, hey, we're going to use this as a way to move money offshore. I mean, Keith, I remember you and I, when we were both at Cross River, would get approached by companies all the time of like, hey, I want to move, USD to wherever country, right? And they're like, I was like, all right, well, tell me how you KYC these people. And they're like, what's KYC?
Yeah.
And I think that like it's fine as a kind of a nominal store of value for somebody, but ultimately, if you need to turn that into something to buy bread, right? How do you do it? And like, that's the part I think like, and like, how do you make the justification of like, hey, we're going to have 50 bank stable coins? Like, I just struggle with, I think it's a super interesting use case. I just don't have a clear view of like the end game at this point.
Yeah, just two quick react. And Jesse, that was a really good point. Thanks for bringing all that up. One is that the card networks, Visa and MasterCard, are leaning into this so heavily, and they have stablecoin backed cards. So on the back of the card is no longer a bank account with USD in it. It's a wallet with stable coins in it. And those are growing pretty rapidly. I think Visa announced that it's grown 4x from last year to this year. The volumes are still relatively small in the billions compared to the trillions that they do, but that is a concept, and that they've proved it out and that the volumes are growing, I think shows that you can potentially in the future buy bread, as you said, using a Visa card that is backed with stable coins.
Without necessarily having to go through the sandwich process?
That's right. A Visa or MasterCard would take care of all that.
Someone's going through the sandwich, right? So like,
I would say, so I think it was, something like 25 years ago that the last time we had a new fiat currency in the euro, right? And that killed a huge FX business in Europe, right? You had, I don't remember all the various different countries' currencies, and then they decided to adopt the euro. I haven't done a whole lot of, in-depth analysis on what that would look like, but I do think at a certain point, you're not going to have multiple different stable coins, and there is a limit. There's going to be a cap of tokenized deposits that gain that critical mass. I don't know what that is. I think it's going to be hard to project. I think there might be some, and I think Nick, you mentioned this, some very specific stable coins or tokenized deposits for certain purposes, certain use cases, and those can be designed for those specific use cases. But yeah, there's definitely going to be a limit to the number of stable coins, the number of tokenized deposits that.
And I assume that's going to be kind of a natural limit that the market can bear rather than something that's superimposed by the government.
That's right.
Yeah.
And it's not the first time we've seen this, right? I mean, if you go back and look at the history of credit cards, I mean, they came out of a very dispersed consumer credit system where every store had its own credit system, and it was unsustainable in that way, and it slowly consolidated down to what we have today, right? I mean, so this is not a completely new situation.
Yeah, we agreed that the alphabet soup at some point has to rationalize into just a few leading consumer stablecoins. Because if you're holding this in Argentina or France or wherever you live across the world, you want to have confidence that you're using the leading stablecoin, or if you're in the US. So that has natural network effects just based on the confidence, the brand recognition, and the acceptance everywhere. We sometimes say that when someone says, I want to launch my own stablecoin, we would say, well, would you launch your own version of FedNow? Because sometimes it is that big of a technology and an acceptance layer. It's quite easy to put something on a blockchain, but in order to get everyone to accept it and to truly create a large network for that stablecoin is a tremendous task. So you may take 2 weeks to do the press release and the tech work, but you might spend 10 years asking everyone to accept it.
Yeah. I think there's a super interesting kind of like other case, right? That probably people aren't necessarily thinking of, because I think what you will end up happening is getting consortium issued stablecoins. And so that you may have banks actually issuing their own stablecoins, but for pledge to the consortium, right? And so like tokenized assets that are effectively kind of like the other side of it, right? The liability side of it is effectively a a bank issued stable coin, right? But it's much more of a transactional instrument that's used to go through a consortium, that's used for kind of like final settlement. And I think there's actually super interesting use cases there, because you think about like the way that Zelle settles and it's a mess, right? Or you think about the way that, you know, the clearinghouse settles, right? It's really just a bunch of like, you know, ledger entries on the back end of it, right? And so I think if you could end up enhancing that and really bringing some efficiency there, that's going to be the kind of the other critical unlock. If you actually said, all right, well, how do you get a community bank back consortium bank stablecoin? Well, you need to really think about the backing side of it, and then how do you create distribution and scale around it? And so there might actually be a bull case there, but it's going to be a little bit harder to say.
Interesting. You know, another question. This is changing gears just a little bit, but not really. Another question that I have, and that I think would be helpful for our audience, because I believe, you know, some members of our audience come from the community banking world, from the credit union world, and there's this question on their minds: how is the digital asset revolution going to affect our business, in particular inflows and outflows? Is this going to lead to more deposits? Is this going to lead to an outflow of deposits for credit unions and banks? So this question I want to direct to Jesse. In your view, do you see the current state of affairs causing net outflows from traditional banks and credit unions, or is there a scenario where digital assets strengthens their business? And what do banks and credit unions have to do to ensure that this strengthens rather than harms their business?
Yeah. So I think like in my view, it's no different than any other product decision you make, right? If you're not creating value and you're just trying to harvest it, right, you're probably going to have a hard time with this, right? And so probably not in the next, 12 months. But if you think about long term, just as like, faster payments are happening, which will end up disrupting your liquidity and like challenging some of your treasury, it's no different than that, right? So you have to figure out a way that you're creating value around this new ecosystem, which would then drive net inflows, right? And so ultimately, if you're able to say, I'm going to be able to, for why I'm going to, a differentiation around something, I think you'll see net inflows, right? If somebody else is doing that to your customers, you're going to see net outflows, right? And so I think that it's much more of a product discussion and a design discussion of like, where do you sit in the ecosystem? If you stay stable, you're probably going to have a problem. But I think that, so that was a bad pun. I think that, I think like realistically, you need to have a position, right? And your position can be like, I don't think this is going to do anything, and this is how I'm going to go against it, right? Or, but you need to, you just can't stay still, right? And I think that ultimately, it has much less to do with, like you're going to launch a stable coin today and you're going to have 100% increase in net deposit, low cost deposits, right? The stuff we did with Cubics, we've been building for 5 years, kind of in some way, shape, or form, and, to get it where it is. And so I think there's a long tail to these investments, and you need to have, you can't be half in it. You have to make a decision on, this is where you're adding value. This is ultimately how it aligns with your customer journey. And then, you need to see it through and realize, I think Nick said it well, right? This isn't a 6-month journey. This is a multi-year journey where you're going to have to do as much education inside your organization as with your customers in terms of what this is, what it isn't, why we're doing it, all the other stuff, just like you would with any other new major product launch.
Mm-hmm.
I think to add on to that, there's some people within the federal government that view stablecoins as a way to help out with the debt. Right. So you're getting access, you're getting a whole new audience to buy treasuries via stablecoins, right? This audience, outside of the US could not buy treasury before. Now, effectively, that's what they're doing. So to a certain extent, that's the Federal Reserve Bank, every other bank should think about this as an opportunity to gain deposits if they do it correctly, whether that's through a consortium or what have you, but there's a way to get more deposits from outside of the US.
It sounds like consortium thinking and collaborative thinking could be very important, especially for the regionals and the community banks. Nick, what were you going to say?
Well, just to echo what Jesse and Keith already hit on, if we are at 3 trillion of stable coins by the end of this decade, by 2030, it resembles a giant money market fund in many ways. Like Keith was saying, that these are primarily going to be in US Treasuries. Now, whether that affects the deposit base or not, that would be the mechanism through which it would. But in some sense, stable coins are exporting those stable coins and those dollars to the rest of the world, who are more likely to hold them rather than use them for payments. They're more likely to use them as a store of value. So it is at the same time as potentially draining some from the US deposit base, an opportunity for the US banking sector to be able to export US banking services across the globe. And in which case it's not coming out of US deposit bases and US economy, it's adding to it by allowing those services to reach a much broader global audience.
It's the United States' biggest export, the US dollar.
Yeah.
But you do have a real problem though, right? Like if that's the use case, because you can't lend against that, right? And so like if you're holding that in treasuries, and it's great, right? You're getting it, but like your NIM is going to be your treasury spread, right? And so you ultimately need to think about in the current environment, right? That's great, but we go back as little as 5 years, right? And that spread was 25 basis points, right? And no one was super excited about Circle, right? Because, they weren't printing money at, a couple of, $1 billion at 4.5%, right? And so I think that, we need to think about what's the business model that sustains, and like banks, I think, full stop, need to lend to their communities, right? If they're just going to sit on capital and deploy it into treasuries, right? We should just do a CBDC, right? Like that's far more efficient, right? That I think that we have to figure out a way that stable coins can create the value and create the acceleration and everything else, right? But like we can't lose sight of, if banks can't lend to their communities, it creates a big problem, right? And right now the current structure, right, makes that very challenging.
So, the way that I think about the financial system, rightly or wrongly, is sort of like a circulatory system. You've got a heart, you've got arteries, you've got little capillaries. And when I think about, who's down at the little capillary level, I think about consumers, and I think about merchants, little stores here and there, all across the country, all across the world. And we've been talking about finance kind of at the higher level, I feel, of the heart and the arteries. And my question to kind of wrap up our conversation, and this is for all of you, is how is this digital asset revolution potentially going to affect the people down at the capillary level? Is this going to make life better for them? Could it make commerce more burdensome for them? And if we want to nudge the industry in a direction that will benefit the consumer and benefit small merchants, the people at the very farthest branches of the system, what do we need to do? So this is both a normative question and a forward-looking question. What could the future look like, and what do we need to do in order to get there for the little guy? So I'll throw that open to anyone who wants to respond.
I'll jump in real quick with just at least in our payments, when we talk about payments, we always talk about the primary issue with consumers and merchants is friction, right? And like you always look at products in terms of, does it decrease friction, and where are those pain points for a consumer or merchant? And so like from a consumer standpoint today, it is a really frictionless, when you go to transact, right? I mean, it's you tap a card or your phone and it's done. Where you see friction in the consumer standpoint is cross-border, right? I mean, it's a pain in the butt. So, I mean, there's a potential, like that's where you kind of look and say, okay, there's a use case right there. For merchants, it's speed and cost, right? I mean, those, like the transactions go very fast, but is settlement as fast as it should be? And how much does it cost? I mean, those are the points of friction for merchants. So I think this product, or any product that kind of hones in on those points of friction, is what is going to succeed. You're not going to replace a system that just works really, really well unless you have a way of making it better. And I think, you got to find those points where you make it better.
Yeah, I would just build off of that on the speed thing. People like to talk about the market cap of stablecoins, and you could think about, market cap of tokenized deposits too. But the velocity, because stablecoins are 24/7 on chain, the velocity of payments on chain is something like 100 times faster. And that lowers costs for merchants, which in turn lowers costs for consumers too, right? So there's inherent in our payment system based off of the legacy fiat bank rails, bank hours. There's capital tied up. There's collateral posted in settlement accounts. Sometimes that's interest that a bank is earning, but that cost then is going down to the consumer or to the merchant. Because the velocity of stablecoin payments or on-chain payments is faster, that cost should over time come down. I think it's also, to Deron's point, going to come down faster for international payments. Domestic, it's pretty frictionless. I don't see us as individuals using stablecoins within the US anytime soon.
So I think it's kind of a generally agree with everyone, right? Friction is a feature till it's a bug. And so I think that you need to think about, if you're a bank and what is your customer going to be expecting of you, regardless of the medium of exchange, right? And so we have Reg E, we have, kind of existing regulations that govern, kind of well-trusted payments. I think that there's probably going to be a challenge with consumers understanding that this is a final payment, and what that means, right? I know Zelle and has lots of issues with it. RTP has lots of issues with it, right? And I think that as this becomes even more synonymous and that, I think that's going to be a big challenge. And so I think that the little guy, and the thing that I worry about in terms of the capillaries, in your analogy of like how it gets down to like, your fingers and toes, right? Is they're going to expect it be what they understand that banks and as financial institutions. Oh, sorry. Can you hear me?
Yeah, we're good.
I was doing well.
Say it one more time so everyone can hear you, because you had a really good point.
Yeah. No, I think, yeah. So I think that, consumers aren't going to understand the difference in payment terms, right? And so like we need to think about where we are in the ecosystem, the trust that consumers put in us, and how, regardless of the medium, we respect that and we're clear about it. And as much as we say, like, as someone who's lost, gotten defrauded out of a bunch of money, there's no one to call when it goes away, right? And so you need to really think about that as a bank. Like, how are you going to deal with that, right? That may be why it's a great B2B use case, but it may not be a great B2C use case, right? And so I think we just need to think about that and ultimately realize that our position, and again, I'll say it, right, is to create velocity around money in the ecosystem. And so that means we need to have trust. It means we need to be able to lend. It means we need to be able to provide access, right? And so when we can do all those things, potentially stablecoins can be revolutionary. But like, if we screw those things up, it'll end up continuing to kind of be more of a niche instrument.
That's very interesting. You're saying that we need to keep the blood pumping to all parts of the body, and if it pools anywhere, then we're in trouble. Interesting. Nick.
Yeah, I struggle to see how it can be net bad for consumers and the little guys, because they'll always have the prior system as well. I mean, for goodness sakes, we're still using paper checks in the country, so nothing goes away overnight. I think folks will adopt it if it is better for them and if they get some benefit from it. There's a whole other side of this that we touch in the banking sector in terms of collateral, being able to use these for collateral for loans and for individuals or small businesses that have any meaningful amount of digital assets. Say they can't get loans against it. And I think in the future they will be able to, because banks will be able to engage with digital assets just like any other assets, and that will be net positive. Smaller merchants or businesses will be able to move money cross border more easily than they can today. So if you imagine what it costs for an international wire transfer, and then just say it, stablecoin send can cost as little as 10 cents. That's a very meaningful delta for managing treasury if you're doing a lot of supply chain or a lot of cross-border trade and transactions. And that's important for the country that those folks continue to thrive. So there are a number of cases where it feels like there's going to be a win. But the average everyday consumer who's just filling up gas in his truck is probably going to be one of the last use cases, and we're going to see businesses who are doing a lot of treasury management, folks who hold digital assets in some way and need to use those as collateral, being some of the very first use cases in 2025 and 2026.
Interesting. Well, this has been an incredibly enlightening conversation and very useful for me as well. We've talked quite a bit about technical issues. We've talked about regulatory issues. From my perspective, and this is probably a conversation for another day, I'm always thinking about the legal structures as an attorney behind our payment system. And as I think about the little guys, thinking about what kind of incentive structures banks, credit unions, fintech companies have to ensure that transactions are effectuated in the best interest of the customers and the merchants and so forth. Again, that's sort of a conversation for another day, but I think it goes hand in hand with these technical questions that we're trying to answer, because as we come up with new technical solutions, it's kind of a green field and we kind of get to determine which rules we want to apply. And so it's a fruitful time to think about both the technical architecture and the legal architecture and the incentive structures. So why don't we, with the last few minutes that we have, take a few questions from our audience. We have some really good ones. I don't think we're going to be able to get to all of them, but we'll be able to get to at least a couple of them. I want to take one from Peter Tapling. Thank you, Peter, for submitting your question. He asks, Genius says tokens must be redeemed dollar for dollar, but it is silent on fees which may be charged. How do you think fee structures will evolve related to stablecoin transactions? What do you think? Deron, do you have a thought about that one?
I mean, go to the basic proposition. There's no such thing as free lunch, right? I mean, there is going to be a fee structure that gets built into this somehow. I mean, there's this old Saturday Night Live advertisement. If you go look it up, the change store. And it's if you look it up and they go, I can give you 4 quarters for $1 and 10 dimes or 20 nickels, and they say, well, how do we make money? Volume. It's not. There's a fee attached to services, so somehow this will get built into this. I mean, it's going to happen. It's not a free lunch.
Yeah, and I think Jesse kind of hit on it too. Friction. I don't know. He said it was a feature till it's a bug, or it's a bug till it's a feature. The convergence of TradFi and DeFi, there's a lot of consumer protections that Visa and MasterCard have built into their network around disputes and chargebacks. And, people can take their view with the networks, but there's a consumer benefit to call up your issue and be like, hey, I don't want, I'm going to dispute this charge. There's nothing like that on chain. And I think it would be ironic, but I do think it's coming whereby, that option is available in the on-chain world where an issuer of a stablecoin, I mean, Circle already has this, it's a dispute protocol or refund protocol, and maybe tokenized deposits, make something similar whereby, for a fee, someone can provide that consumer protection.
I think the challenge though with Keith with that, right, and you know it as well as I do, right, is that the dispute mechanism that Circle offers, right, that money is usually 7 wallets down the chain. And so the ability to actually dispute anything, good luck, right? And so I agree with you, right? Like this is something I'm deeply passionate about, right? Like we have to think about, it needs to be a better version of banking, not just a different version of banking, right? And it has the potential to do that, right? I think that the underlying tech of these things, if you want to geek out, I'm happy to geek out with somebody on like, ERC20 smart contracts and all the things you could do. But like ultimately, this is the future, right? Whether or not we could disagree or have different opinions on what that is, but like, will there be fees? Absolutely. There are fees today, right? But the fees should be commensurate with the value provided or they won't work, right? People won't adopt it. And so I think that, there's things today that need to get solved, like gas, right? Which is not going to work for consumers, right? Like they're not going to hold some secondary token in order to pay for their transaction, right? So like, I think there's lots that needs to be solved here. The good news is you don't have a piece of paper and then you have to solve for everything around that piece of paper, right? You actually have the logic in the code, and that you can embed that and make it a better version of that piece of paper, but it's going to be challenging.
Well, it looks like we might have time for one more question. And this one's a bit of a spicy one, which is one of the reasons I like it. This is from Philip Knight. Thank you, Philip, for submitting the question. He said, in the context of Jesse's question about will there be an Uber moment in this space before the Genius Act implementing regs are written and completed? Philip is interested to know what our panelists think about paying yield on stablecoin and the seeming end run that is playing out now where the issuer isn't paying yield, but the facilitators and exchanges are paying yield and promoting staking. This is a spicy question because I think this is one of those sort of points of friction that we talked about with Deron in the implementing regs. If we had to guess where or how this issue will be resolved, what do you think? Where's it going to land?
I mean, from a capitalist perspective, I think the market will determine there's different quality of yield, right? Yield to increase circulation of a stablecoin is different than yield earned off of deposits at a bank, earned off of, other real world assets that have been tokenized. Whether those are equities or corporate debt, what have you. People can wrap their head around yield paid from tokenized corporate bonds or the Fed treasuries, other types of yield. I think as more traditional financial institutions adopt digital assets, I think they'll see through some of those less legitimate forms of yield.
Yeah, there's no free lunch, right? And so ultimately, as we said before, right, someone's going to pay yield and you're going to have to figure out why, right? And that there's going to be inherent risk. And I think there will be, whether it's a bank or it's a, whoever, like you have like what Figure is doing right now with the YLDS security. I think there'll be people out there who say, hey, Coinbase is trying to do with the rewards thing, right? I think there'll be people who different flavors of it, but ultimately, if they're paying you, they're taking it from some point of that cycle if other people aren't, right? And so I think there's going to have to be a rationalization of like, all right, well, you may have, I remember I had money frozen in the whole Gemini kerfuffle, in 2022, right? Where they effectively had all these funds and they were using it as a yielding instrument. And like, I was getting an extra 100 basis points, but then I couldn't access my money for a year and a half, right? Net trade wasn't worth it in hindsight. So I think that, there's going to have to be a rationalization. And yes, there'll be people who pay yield, but like, there's probably going to be some amount of consumer awareness that needs to be driven by that underlying instrument.
Well, thank you again. We're going to have to stop there. We're at the hour. Keith, Deron, Nick, Jesse, you are amazing. Thank you so much for your thoughts, and thank you for taking the time, and thank you to AFC for allowing us this opportunity.